let's now discuss loan accounts. Loan accounts, we need to remember, are not part of equity. That's our starting point for this discussion. So what are loan accounts? Well, sometimes partners may loan money to or borrow money from the partnership. This is a separate item from current or capital accounts or drawings accounts. Totally separate. Okay. This loan will usually have repayment terms, which will be made up of fixed amounts on fixed dates with a fixed payment period. Each payment will consist of principal, the capital amount, as well as the interest thereon. Obviously, if there's interest, we must stipulate the interest rate. Please remember that interest expense or income are not part of your appropriation accounts or current or capital accounts that we've discussed previously. They will go to profit or loss in the statements of profit and loss, okay, as either other expense, finance costs or other income. So what are these loan accounts going to be? If it's a loan money to the partnership, so if partners are giving money to the partnership, then it will be a liability for the partnership. If the partnership is loaning money or borrowing money from the as a partner borrows money from the partnership, okay, so the partnership then gives money to the partner, then for us as a partnership, it's an asset. We will get that money back. It will be a receivable. Okay, so let's have a look at the journals. I've split the journals up into the liability versus the asset journals. So here, for liability, the partner gives a loan to the partnership, and therefore the partnership has an obligation to settle the loan in the future. So on day one, we will debit bank. Let me pull up a highlighter quickly. We will debit bank as the partnership. Remember, we the partnership, and we will credit the liability with a loan from partner A. Nice and easy. Then interest is going to accrue on this loan, and it's an interest expense because we've borrowed money from the partner. We, as the partnership, must pay interest to the partner. So that will go debit interest expense. As I said a few moments ago, that will be in profit and loss under finance cost. Nothing to do with the appropriation account, please. Then either we will pay the interest straight away, credit bank, or we will have to accrue the interest, which is a liability. That's a payable. Let's assume for a second that we've done the accrual, not the payment. Okay. Then at a later date, we will pay the accrued interest expense. And then we will debit the liability and credit bank when we make that payment. Now remember journals, let's give these journals numbers. So that's journal 1, journal 2, and journal 3. Now remember journal 3, if the interest was paid straight away, okay, every month as it's incurred we pay the interest, well then there's no need to do accrual. And you'll only have debit interest expense, credit bank. Okay, but that's not generally how it works in the real world. Generally we will accrue interest and we'll pay it later on. Then we need to settle the loan by repaying the principal. So if we borrow 100,000 Rand from the partner and we pay interest of 10,000, the interest is on top here. Here I'm talking the principal will be the 100,000 capital, the principal amount payable back. When I settle that liability, we will debit the liability, make it smaller, and we will credit bank. Okay, remember liabilities, ladies and gentlemen, do what? They get bigger on the credit side and smaller on the debit side. So here we will debit the liability to make it smaller because we settled it. Okay. They will all go through to a general ledger account, and let's talk about partner A having a liability. Let's go and now post the journals to the general ledger account. So I'm going to go back and forth a little bit, so bear with me. Here we are crediting the liability with a contra account being bank. So that will be journal 1. We credit the liability, the contra account is bank. Okay, journal 2, we go debit interest expense and then we credit, let's assume the accrued interest account. So that is journal 2. We'll have a credit, not to the liability, but to the accrual liability. And we will credit interest expense, and this will be journal 2. Okay, and when I say credit interest expense, we're crediting the accrued interest account, and the contra account is interest expense. Okay, let's go back now. Journal 3. Here we are settling the accrued interest. So I debit accrued interest, debit the accrued interest with the contra account being bank. Final journal is the settlement, journal 4. We settle up the remaining loan balance. And I'm debiting the liability. So that is journal 4. I debit the liability account. The contra account is bank. Okay, so we should know how to do that. And yes, we'll then have a closing balance. Take note here, all the closing balances are settled up. We do our little balancing figure, bring it forward, and we land up with a credit balance because we are dealing with a liability. Let's have a look at it the other way around. What happens if the partnership was granted a loan, okay, partnership grants a loan to a partner. Okay, so it's the other way around. The partnership's giving money to the partner, and the partner needs to repay the partnership. That's a receivable, which is a benefit, which we should know by now. It means it's an asset. So on day 1, we will pass journal 1, which is debit the asset and credit bank. Okay, we credit bank because the cash flows out, and we increase the receivable. Remember, assets get bigger on the debit side and smaller on the credit side. So we are increasing the asset by debiting it. And we're saying this one's now to partner B, right? Then we have interest income on the loan, okay? It's not part of finance cost, apologies. That should not be in finance cost. I want you to write this in. This will be part of other income. Okay, I made that note specifically, guys. I want you to realize that interest income is going to be separated from interest expense. Interest expense was going to be under finance costs. Interest income will be other income. Okay, so please make a note of that. Don't just leave it like this. Okay, asset, interest receivable, we will debit. Okay, and we will credit the interest income as part of other income. Sometimes, yes, sometimes we may actually just pay this or receive this interest income straight away, then we'll debit bank. Let's assume that we accrue the interest income and then debit a receivable. Let's call that journal 2. Okay, then we actually receive the interest from the partner. We debit bank and we credit interest receivable, and what are we doing here? We decrease the asset by crediting it. Last up, there's a receipt of the principal by the partnership, journal 4, and here we debit bank and we credit the asset, the loan to partner B. Okay, we make the asset smaller. Great, let's once again post these across to our general ledger. I'm going to do that in red. Bear with me while we go back and forth. So journal 1, we are debiting the asset, and that asset's called loan account partner B. So we debit the asset, and the contra account is bank. We then need to raise the interest accrual. So I'm going to do an interest receivable account, and we are going to do that from journal 2. We are debiting the asset, interest income. Okay, it's an accrued interest. Our contra account is an other income account called interest income. Journal 3, we then receive the interest that is accrued to us, and that will be a credit to the interest receivable account. Last up, journal 4, we credit the asset, the loan, to partner B, and that contra account will be bank, journal 4. Now, if you have a look carefully, you will see that we have been left with a debit balance on both of these, or a zero balance. If it's a credit balance, well, then you're dealing with a liability, not with an asset. Okay, so these two accounts, either a liability loan account or an asset loan account, are separate to the capital and current accounts. They have nothing to do with the appropriation account from an interest income or expense perspective. Interest income is taken to other income. Interest expense is taken to finance charges. Okay, please keep this separate from any equity accounts. Thank you.